Okay, stop what you are doing and look at the ticker. Seriously, pull it up. We need to talk about Wednesday, February 4th. If you were watching the market, you saw something that, frankly, we just haven't seen in the office REIT sector for a long time. We are talking Brandywine Realty Trust ticker BDN.
It didn't just wiggle, it popped.
It absolutely popped. A surge of over 13% in one session. It closed at 317 on, just massive volume, almost 5 million shares.
It's the kind of move that makes you put down your coffee. You have to pay attention. When a sector is as battered as office real estate, a move like that signals something big is happening.
A real shift.
Yeah, the market is sniffing out a turnaround, or at least a stabilization that the bears were just not positioned for.
And that is exactly what we're going to do on this Talk Tickers deep dive. We're going to figure out why the market suddenly fell in love with this stock. We've gone through the Q4 earnings call, line by line.
And it's not a victory lap, let's be clear.
Not at all. It reads more like a survival manual. It's a tale of two very different cities. You've got Philadelphia and you've got Austin, and a really high-stakes game of balance sheet engineering.
It's the classic better than feared story. The management tone was, I'd say, cautiously constructive. They're basically saying, look, we have a fortress in Philly, a mess in Austin, and we are going to sell our way to safety.
All right, before we get into the Philly-Austin split, let's just hit the headline numbers that got the algorithms firing. They delivered a double beat.
They did. Revenue came in at about $121 million, beating by over $4 million.
Okay, but the bottom line is, where I want to push back a little, GAAP EPS, it was a loss of 21 cents. Now, that was 2 cents better than expected. Right. It's still a loss. Why is the market cheering a company losing 21 cents a share?
Because, in the REIT world, especially right now, GAAP earnings are almost irrelevant. You have to look at FFO funds from operations.
Right.
Q4 FFO came in at 8 cents per share. Now, I know what you're thinking. 8 cents doesn't sound like a blockbuster.
It doesn't.
But you have to strip out the noise. That 8 cents includes a huge one-time hit, a $12.2 million loss on the early extinguishment of debt.
Okay, early extinguishment of debt. Unpack that for us. It sounds like a penalty. Is that a bad thing?
In this context, it's actually strategic pain. They paid a penalty to pay off some debt early or just reorganize it. That one charge knocked about 7 cents per share off the FFO.
Okay.
So if you add that back, the operational engine is actually running closer to 15 cents a share. That's a much, much healthier number than the headline.
So the core business is humming along louder than it looks on paper.
Precisely. And then they issued 2026 guidance for FFO between 51 and 59 cents a share. In this market where everyone is terrified of guidance cuts, just seeing that range implies stability.
And right now, stability is worth a premium.
A huge premium.
But, stability is a nice word. But when I look at the operational breakdown, stable really only applies to half the company. Reading through the transcript, it feels like Brandywine is running two completely different businesses.
The divergence is incredibly stark. It's a perfect case study of the post-2020 real estate divide. So let's start with what they call the Philly Fortress.
Okay.
Management said their CBD and University City properties in Philadelphia are 95% occupied and 97% leased.
Hold on. 95% occupied in an office REIT in 2026. And that sounds suspiciously high. Are they just giving the space away?
That's the logical question, right? But the data says no. It actually proves that flight to quality thesis we keep talking about. Tenants are shrinking their space, yes. But the space they do keep, they want it to be premium.
Top of the line.
Exactly. Brandywine captured 54% of all new leasing in their main Philly submarkets last year. They aren't just surviving there, they're basically eating their competition's lunch.
And you're saying they're not just discounting to fill the lobby. I saw a stat on rents that kind of shocked me.
This is the key metric. Since 2021, net effective rents in those Philly submarkets are up almost 20%. That's over 5% a year. So not only are they full, they have pricing power.
Wow.
That's the definition of a fortress asset. As an investor, you look at Philly and you say, okay, the cash flow here is safe. It's real.
But then you look south to Austin, Texas, and frankly, it just looks like an anchor.
The Austin drag is real, and it is heavy. While Philly's at 95%, the Austin portfolio is sitting at 74% occupancy.
Okay.
And management admitted on the call that Austin alone is dragging the company's overall leasing levels down by 400 basis points. If you could just surgically remove Austin, this would be a totally different stock.
And it doesn't sound like it's getting better anytime soon. There was a very specific tenant issue that came up. We need to talk about IBM.
Yep, this is the dark cloud. IBM is moving out of their Uptown development at the end of Q1 2027. We are talking about a huge block of space coming back to the market in a city that's already oversupplied.
So what's the plan? They can't just hope someone else moves in.
No, they have to get aggressive. They laid out a plan to redevelop another vacant building they have in Austin, about 157,000 square feet. They're planning to spend about 30 to 40 million on renovations.
Wait, start there. They have a vacancy problem, and their solution is to spend $40 million. Isn't that just throwing good money after bad?
It's a defensive calculation. They're targeting an 8% cash return on that spend. The logic is this building is obsolete as it is. If we do nothing, it stays empty. If we put 40 million in, we can make it competitive enough to steal tenants from other older buildings.
So they're betting they can out-renovate the weak market.
That's the gamble. They also touched on life sciences. There was some talk about the 3151 Market project.
Right, that's their mixed use. 60% office, 40% life science. They use the phrase green shoots. And I hate the phrase green shoots. It usually means we haven't signed a lease yet.
You're cynical, but you're not wrong. The CEO, Jerry Sweeney, was actually pretty honest about it. He said, and I'm quoting, "The entire life science market needs to see those green shoots grow into trees."
So he's tempering expectations.
Exactly. He's saying, we see interest, but don't model in a windfall until the biotech funding world really thaws out.
Okay, so let's pull back. Operationally, you have a rock-solid Philly core that's funding a turnaround attempt in a very troubled Austin market. But let's be real, a stock doesn't pop 13% because of a renovation plan. This is about the balance sheet.
Absolutely. This is a story about money and debt. The 2026 business plan is built around one big number, $280 to $300 million.
The asset sale target.
Correct. They need to sell $300 million worth of buildings, and they're targeting exit cap rates around 8%. Let's pause on cap rate. An 8% cap rate means they're selling a building for a price that gives the buyer an 8% annual cash return, right?
Exactly. And in the zero interest rate days, these buildings sold at 4 or 5% caps. So selling at 8% means they're accepting a lower price.
A much lower price.
But, and this is the key, management is being realistic, they're not holding out for 2021 prices. They're saying, we'll take the market price because we need the cash.
And why do they need the cash so badly?
They need to pay down the credit card. The number one priority for that cash is debt reduction. They have a maturity wall coming, a $178 million construction loan that matures in July 2026.
July 2026. In real estate time, that's basically tomorrow.
It is. And this brings us to the really interesting part of the call, the portfolio engineering. They recently bought out their partners on a couple of big projects, which put that $178 million loan squarely on their own books.
Which sounds risky. Why add debt when you're trying to get rid of it? Control.
Yeah.
It gives them total control. Their plan is to refinance that loan very soon, maybe early Q2. They want to split it. Get a secured loan on the residential part of the project, maybe $100 million, and use their corporate credit line to pay off the rest.
And that would do what for the office part of it?
It would unencumber the office portion.
Unencumber. That's the magic word. Why is that so important?
Think of it like your house. If you have a mortgage, the bank has a lien. An unencumbered asset is free and clear. It gives them massive flexibility. They can pledge it for an emergency loan, or they can sell it cleanly without needing a lender to sign off.
So it's a safety net.
A huge safety net. They ended the year with their core portfolio 100% unencumbered. Plus, they have a fully undrawn $600 million revolver and over $30 million in cash. They're not running on fumes.
But there's another lever they can pull. We talked about selling assets at an 8% cap rate. But management also mentioned over half of their own bonds have coupons north of 8%.
This is the arbitrage. This is the math the CFO is working on right now. If Brandywine sells a building yielding 8%, they lose that income. But if they use that cash to buy back their own bonds that are paying 8 or 9% interest.
It's a wash on cash flow, but the debt pile shrinks.
Exactly. It de-risks the entire company.
Yeah.
And they estimated retiring those high coupon bonds could save them about 10 cents per share in earnings, you're literally selling bricks to buy back paper and making the whole company safer.
So the strategy is shrink to survive, or maybe shrink to grow.
And the market loves de-risking. That's why the stock popped. The market saw that $300 million sales target and said, okay, the bankruptcy risk is off the table for now.
We should just touch on the macro picture. The stock is around $315, but in the Q&A, someone asked about net asset value, what the buildings are actually worth.
The consensus NAV is around $8 a share.
Wait, the stock is at $315? The assets are worth $8. That is a massive gap.
That gap is the fear discount. It's the market saying, we don't believe you can get that value. But if they start hitting these sales targets, if they sell that first $100 million in assets, that gap has to close. You are buying $1 for 40 cents.
There was also a management change. George Johnstone, the EVP of operations, is retiring. Is that a red flag?
I don't really read it that way. He's been there a very long time. I think it just marks a changing of the guard as they pivot this strategy. It's more of a natural evolution.
Okay, so let's put it all together. The stock pop suggests the death spiral is paused. It feels like a binary bet now. If they sell the $300 million in assets, they survive, they refi the loan, and they're a smaller, leaner company.
And if they fail to sell, if the market freezes, then all these capital structure problems come roaring back in 2027. But for right now, the momentum is on their side.
All right, let's pivot. This is the part of the show where we pitch a trade idea. And I have to say it loudly. This is not financial advice. We are just two voices exploring the data. Do your own work.
But if you are a hedge fund analyst, this is what you might be pitching to your committee right now.
The setup is clear. The stock topped, which is great. But the real tell isn't in the equity market, it's in the bond market. This is a capital structure arbitrage play.
I like it. The stock is pricing in a recovery to maybe $354, but the bonds, specifically the 2028 notes, are still yielding high numbers. They're still pricing in some distress.
Exactly. And management basically said they might buy back these bonds. So here's the trade. You go long the 2028 bonds.
What's the payout on that?
You're betting on the tender offer. You're betting they sell the buildings and use the cash to come buy your bonds back. You get paid a high yield to wait, and the company itself is your potential buyer. It's safer than the stock.
That's the safety play. But you still have company risk. You need a hedge.
Right. You have to hedge the Austin drag. So you short Austin-specific residential exposure. You find a competitor, a residential REIT with heavy exposure to Austin apartments.
Because if the Austin market softens even more after IBM moves out, that short position pays off and it offsets any weakness in your Brandywine bonds. That's a sophisticated pair trade.
It's long the balance sheet repair, short the specific market weakness.
You like?
Or, if you want the wild kicker, the squeeze play.
Let's hear it. I know some listeners want this one.
If they execute that $300 million in sales early, say in the first half of the year, the short interest on the stock gets absolutely crushed. So you buy call options on BDN for July 2026. Why July?
That lines up perfectly with the loan refinancing news.
Exactly. That's the catalyst. You buy the calls, and you can finance them by selling puts on the Philly Fortress.
So selling puts means you're betting the stock won't go below a certain price. You're betting the Philly portfolio creates a floor.
Right. You're betting 95% occupancy in Philly puts a floor under the stock while the asset sales blow the ceiling off. It's aggressive. If it crashes, you own the stock. But if they fix the balance sheet by July, the re-rating could be violent.
It all comes down to execution. They have to sell the buildings.
So let's recap. Brandywine Realty Trust delivered a quarter the market loved. They beat on revenue, they beat on FFO when you look past the one-time charges, and they proved Philadelphia is a fortress.
But they also looked everyone in the eye and admitted Austin is a problem. The entire year of 2026 is going to be defined by one thing. Can they sell $300 million in assets?
The market bought the less bad news. The 13% pop proves that. Now management has to go out and actually do it. That's the gamble.
It's a high wire act, but for the first time in a while, it feels like there's a net underneath them.
Keep your eyes on the ticker. Thanks for listening to The Deep Dive.